So we have been discussing the topic of external reconstruction. We have been discussing the topic of reconstruction. And remember, we had said there are two ways of reconstructing a company. One way was what we were calling internal reconstruction, and we finished that topic of internal reconstruction. Then we said there is a second way you as a company you can reconstruct yourself, and that is through what we were calling external reconstruction. That's what we want to discuss now. So let me assume that we are reconstructing a company called A Limited. We said when a company is reconstructed through external reconstruction, then that company must be liquidated. And then they will sell their business to another company. Let's call it company B. And we want to assume company B can be either a newly formed company, it can be a newly formed company, or it could be another existing company And so we said, when it comes to external reconstruction, a company is liquidated and sell their business to another existing company or a newly formed company. Now, company A, we said, is to be liquidated. And so company A is selling. And so company A is selling their business. So we shall be referring to company A as the selling company. While company B, which is purchasing the business of company A, we shall be referring to company B as the purchasing company. We shall be referring to company B as the purchasing company. Okay, good. Now, company A has to be liquidated, meaning they have to close their books. All the stakeholders of company A, when a company is liquidated, assets are sold and the stakeholders are paid. So company A, normally they have to close their books, while company B, which is buying company A, company B will open their books. So whenever you are given a question of external reconstruction, the examiner would want to ask you to show the entries in the books of the selling company. That is, how do they close their books? And he would also want to show the entries in the books of the purchasing company, which is the company purchasing A Limited. So you will be told to close the books of company A, and you will be required to open the books of company B. So let me go through the accounting entries in the books of the selling company. That's what we want to discuss now. Don't write. We are saying what are the accounting entries? Entries in the books of the selling company. Entries in the books of the selling company, which we are assuming it's company A. They are selling their business to company B. So they have to close their books so that they sell their business to company B. I've also told you, whenever a company is liquidated, the stakeholders have to be paid. So finally, we have to pay the stakeholders of company A so that they sell their business to company B. So what are the accounting entries? So let me go through them now. Number one is, you as company A, it could be that you are giving some of your assets to company B, meaning company B takes over your motor vehicle or furniture or building and so on. So one thing you have to find out is which assets is company A giving to company B. So step number one is we close all assets taken over. You close all assets taken over at their book values, to an account we shall be calling a realization account. Close all assets taken over at their book values to an account we shall be calling realization account. So let me open it somewhere here. We want to open an account called realization. we are closing all assets. You know assets are always a debit balance. And therefore, to close them, you have to credit the asset. It means you have to debit realization. So that's step number 1, which says close all assets taken over. Close all of them by crediting the asset and debiting realization. And we are saying you close them at their book values. That's number 1. Number 2. Again, don't forget, we as company A, we are selling our business to company B. So number 2, again, listen. Number 2, you may as company A, let's look at it, company B. Company B may say they're also going to take over your liabilities. Maybe creditors, maybe they are going to take over your loan and so on. So it means that you, company A, you are giving some of your liabilities to company B. You are giving some of your liabilities to company B. So our step number 2 says close, or we can put it this way. Don't write. I've said don't write. We shall give out the notes later. With liabilities taken over. With liabilities taken over by the purchasing company, of course. You know liabilities are always a credit balance. Therefore, to close them, you will have to go debit those liabilities and you will have to credit realization. So that's our step number 2 that says with the liabilities taken over, whether creditors, whether bank loan or bank overdraft, all the liabilities that were taken over from you as company A, you close them to the realization account by debiting liabilities and you credit realization. That's step number 2. Good. We go to number 3 now. We go to step number 3. What is it about? Listen, you as company A, you are selling your business to company B. There must be something which you as company A, you are charging company B. What is it that you are charging company B? Whatever it is that you are charging company B, that is what we shall be calling the purchase consideration. So step number 3 says, with the purchase consideration, what is it that you as company A, you are charging company B? Let us assume for purpose of illustration that you as company A, you are charging company B 50 million to buy you. I'm not saying they are paying you 50 million now. No, you are charging them 50 million being the purchase consideration. What is the accounting entries? So our entry number 3 says, with the purchase consideration, you will debit the purchasing company, whichever is your purchasing company, which in our case here we are assuming is company B Limited. So you will debit the purchasing company and you credit realization. Let us assume we are charging them 50 million. You will debit the purchasing company and you credit realization, and you come and say, yeah, B Limited 50 million. Now listen, when I'm debiting B Limited, I am creating a data. We are company A. We are creating a data by the name of company B. So when I'm debiting B Limited, here I am creating a data. Who will later pay me? Who will later pay me in a few entries from now. But for now, as at now, me as company A, I am charging them 50 million. I create a data. That's our entry number 3. Number 4. I have also told you company A has to be liquidated. Company A has to be liquidated. That's what I said. Whenever a company is liquidated, they may incur some cost to liquidate themselves, because they must liquidate themselves so that they sell their business to company B. Suppose they need some money to liquidate themselves. Maybe they need 2 million shillings for liquidation expenses and so on. So our entry number 4 says, with liquidation expenses, if you as company A, listen, if you as company A, you paid for yourself that amount of liquidation, maybe you need 2 million, 1 million to liquidate yourself, you will debit realization and you will credit bank. You will debit realization with that amount of the liquidation expense and you will credit bank, whatever it is. But there are times when the question might tell you, listen, that company A did not have the 2 million they needed to liquidate themselves. Listen, it's true. It's their responsibility for them to liquidate themselves so that they can sell their business to company B. But suppose they don't have the 2 million to liquidate themselves. But you B, company B, you still want to buy them. But they don't have money to liquidate themselves. What do? You decide, listen, you as company B, you decide that you're going to pay the 2 million on their behalf. If you decide you're going to pay their 2 million on their behalf, it means, listen, it means company A is incurring that expense, but they're not the one paying. They will pay that expense later when they receive the money from company B. But you, A, you are the one in charge of that cost. It's your cost. You are supposed to liquidate yourself. So the point is this. If the question tells you that the liquidation expenses of company A were paid for by company B, then it means company A incurred it but never paid. They only incurred but never paid. So if they incurred but never paid, what do you do as company A? You will debit realization and you will credit an account called provision for liquidation expense. You will debit the realization account and you will credit an account we shall be calling provision for liquidation expenses. Provision for liquidation expenses. Meaning, listen, it's your cost. You are incurring it. You will pay it later. So, but create a liability now to be paid later. So I want to create a liability of 2 million so that when I receive the money from company B, I'll be able to pay that 2 million. So I debit realization and I credit this account called provision for liquidation expense by whatever the amount the question tells you is the liquidation expense. So you find in most questions, listen, in most questions, the question will tell you it is the company B that paid for the liquidation of company A. Meaning that you, company A, you incurred but never paid. You incurred but never paid. So you will debit realization and credit provision. Otherwise, we have said, if you are the one who paid for yourself, you A Limited, you will still debit realization but credit bank. Good. That's our entry number 4. I go to number 5 now. What's our entry number 5? For number 5, I want to take you back to number 1. For number 5, I want to take you back to number 1. Number 1, we said, close all assets taken over. Close all assets taken over at their book values. All assets taken over. Suppose, listen to this now. Suppose company A has an asset which company B does not want to take over. Maybe they don't want to take over your motor vehicle, or they don't want to take your furniture. What do you do as company A? And yet, listen, and yet we are saying, you company A, you must liquidate yourself. And when you liquidate yourself, you can't leave some accounts pending. You can't leave some of the accounts pending. No. So you may decide that you, company A, you will look for somebody to buy that motor vehicle. That means you sell it on your own. So our entry number 5 says, with any assets not taken over, with assets not taken over by the purchasing company, but sold by the selling company. You as company A, you sold your own motor vehicle, or you sold your own furniture, or you sold your own building, whatever it is that the question will tell you. How do you debit? Which account do you debit? Obvious, you will debit bank. You will debit bank and you credit the asset. Let us assume it's a motor vehicle. So you will debit bank and you credit motor vehicle. Let me assume the book value of the motor vehicle was maybe 2 million. And the question tells you you sold it for 1.5 million. So you will debit bank by 1.5 million and you will credit motor vehicle account. You come and see your bank 1.5 million. Listen, But don't forget, we have sold motor vehicle. But when you look at this motor vehicle account, it has a balance. So that balance is either what we call the gain or loss on disposal, is what we call the gain or loss on disposal. Whatever is the gain or loss on disposal, you take it to the realization account. Don't forget, we are using realization as our operating account. We are using realization account as our operating account, So you will debit with the balance in the motor vehicle account. Like now, it is a loss. We sold a motor vehicle whose book value was 2 million. We sold it for 1.5 million. That's a loss of 500. You will credit motor vehicle and you will debit realization. Otherwise, if you sold that motor vehicle for 2.5 million, if you sold it for 2.5 million, when it had a book value of 2 million, then you must have sold it at a gain of 1 million. That gain, we are saying, take it to the realization account. So that's our entry number 5, which says, with any assets not taken over by the purchasing company, with any assets not taken over by the purchasing company, but sold by the selling company, then you will debit the asset. No, you will debit bank, credit, asset. Good. Then I've said with the balance in the asset account being either gain or loss on disposal, take it to the realization account. Good. That's our entry number 5. Let me go to number 6 now. Let me go to number 6. For number 6 again, listen. For number 6 again, I want to take you back to number 2. For number 6, I want to take you back to step number 2. Step 2, I told you, with the liabilities taken over, we are to debit liabilities to close it. We are to credit realization. Okay? Now, suppose company B did not want to take over your creditors or your bank loan, yet we are liquidating company A. You cannot liquidate a company and leave some accounts pending. What do? It is at this point now again, you as company A, you may decide to pay for yourself that liability. So our step number 6 says, with any liabilities not taken over, but paid by the selling company. So you company A, you paid it for yourself. That bank overdraft or that creditor or that bank loan, you decided to pay it on your own. Let me assume it's creditors. Let me assume the amount was creditors. That company B did not want to take over the creditors, so you decided to pay that creditors on your own. So you will debit creditors. Don't forget, creditors is a liability. Liabilities are always a credit balance. Let me assume it's 2 million. Then the question could tell you, listen, the question could tell you that the creditors were willing to accept 1.8 million in full settlement. 1.8 million in full settlement of the debt. So you are paying creditors, you will debit creditors, of course, and debit bank by, debit creditors and credit bank by 1.8 million. But then don't forget, we have settled the amount in full. We owed them 2 million, but they were willing to accept 1.8 million in full settlement. 1.8 million in full settlement. Okay, so which means it's like the creditors have given us a discount. The creditors have given us a discount of how much? Of 200,000. So how do you deal with it? That's a gain to us. Remember, that's a gain to us. We owed them 2 million. They are willing to accept 1.8 million. So as a company, we are gaining. We shall debit creditors and credit this account we are calling realization account. So that's our entry number 6, which says, with the liabilities not taken over but paid by the selling company, you debit liability and you credit bank. Then we are saying, if there is any discount we are receiving from creditors, you will debit creditors and you credit realization. Of course, don't forget, listen, We are not running a normal business. This 200 discount, if it was a normal business, I would have taken it to the P&L account. It's a gain to us. But now we are not running a normal business. We are closing this business, or we are liquidating this business. We are taking that 200 to the realization account. That's our entry number 6. Let me go to number 7. Number 7. Now listen carefully for number 7. Number 7, before I go to that number 7, I told you this, that company A is being liquidated. I also told you, when a company is liquidated, the stakeholders are paid what is due to them. The stakeholders are paid what is due to them. One group of stakeholders in this company are the ordinary shareholders. Another group of stakeholders could be preference shareholders. They have to be paid what is due to them. Now listen. Let's take the ordinary shareholders for instance. In a company, the company normally owes several things to the ordinary shareholders. One thing that you as a company you owe to your ordinary shareholders is their share capital. You as a company, you also owe any reserves in a company. Any reserve in a company normally belongs to shareholders. So we are saying there are several things that you as a company A, you owe to your ordinary shareholders, whether in terms of ordinary share capital, share premium, general reserve, revaluation reserve. All these are things that belong to the shareholders. Now listen, we can't pay them what is due to them through those individual accounts. That means if I owe them 20 million for their share capital, we normally don't pay them their share capital through their share capital account. We don't pay them their share premium through share premium account. We don't pay them their reserves, maybe general reserve through general reserve account. No. Listen now. What you do, you as company A, you will create one liability account. For who? For the ordinary shareholders. You will create one liability account for the ordinary shareholders where you will transfer everything that belongs to them to that account. You will transfer everything that belongs to them to that account, so that when it comes to the time of payment, you pay them only once, but not in piecemeal. We don't want to pay them what we owe their ordinary through ordinary, what we owe them for reserves, share premium, we pay them through share premium. No, we consolidate all that into one liability account. Then we pay them only once to settle everything, instead of paying them in piecemeal. That's what I want to do in step 7 now. So step number 7 says, transfer the balance. You now transfer the balance of the ordinary share capital to a liability account that we shall be calling. You transfer the balance of the ordinary share capital to an account we shall be calling ordinary shareholders members account. To an account we shall be calling here. Let me open it here. We call it ordinary shareholders members. Ordinary shareholders members. Some books will call it ordinary shareholders sundries members account, whatever the question will call it. Some questions or some books will call it ordinary shareholders members. Some books will call it ordinary shareholders sundries members account, whatever it is that they call it. Good. So let me transfer the balance of the ordinary. Our ordinary share capital, you all know, is a credit balance. Ordinary share capital is a credit balance. So you will debit share capital and you will credit this account called ordinary shareholders members. You come and say your ordinary share capital, whatever it is. That's our step number 7, which says transfer the balance of the ordinary share capital to the ordinary shareholders members account. Good. We now go to step number 8. That's our step number 7, which says transfer the balance of the ordinary share capital to the ordinary shareholders members account. Now we go to step number 8. I've told you, listen, I've told you there are several things that as a company we owe to our ordinary shareholders. Other than share capital, we owe them reserves, whichever form of reserve, whether share premium, general reserve, revaluation reserve, retained profit, whether positive reserve or negative reserve, it belongs to them. So our step number 8 says transfer reserves. Again, transfer reserves to the ordinary shareholders members. You transfer reserves to the ordinary shareholders members. Reserves can be either positive or negative. Positive like share premium, maybe revaluation reserve, and so on. Negative reserves like retained losses. Of course, the company has been making losses. Don't forget that. We are reconstructing this company because they have been making losses. So they have always retained losses. So it's a negative reserve. So we are going on to say under number 8, if the reserve is positive, if it is a positive reserve like share premium, you will debit that share premium because it's a credit balance. You will debit that share premium and you will credit the ordinary shareholders members. It could be a positive reserve like share premium. You will debit the members, you will debit share premium, you will debit share premium and you credit the ordinary shareholders members. It's an amount that belongs to them. So let's bring it to this liability we have opened for them. And we come and say a share premium. I'm using it as an example of a positive reserve. Otherwise, it could be revaluation reserve, it could be the general reserve, and so on. Still, under number 8, what if it's a negative reserve? Like which one? Like retained losses. Meaning, if you go to the P&L account of this company, you will find a retained loss. A retained loss is a debit balance. Losses are always a debit balance. So we want to give the owners of this company their share of that loss. Okay? It's a reserve, but a negative reserve. So you will credit the P&L account because I've said reserves, negative reserve like share P&L, retained losses are always a debit balance. So if it's a debit balance, to write it off, you will credit P&L account and you will debit the members. You come and say a P&L account, whatever it is, as the retained loss. That's our entry number 8, which says transfer reserves to the members. I've said if it's a positive reserve, e.g. share premium, you will debit share premium and you will credit ordinary shareholders members. If it's a negative reserve, like the retained losses, you will credit P&L account and you will debit the members. You will debit the members. That's our step number 8. Let me discuss number 9. Number 9. Now, for number 9, listen. For number 9, I want to take you back to number 1 and number 5. For step 9, I'm taking you back to number 1 and number 5. For step 9. Number 1, we said with assets taken over. That's what we saw. With assets taken over. Number 5, we said with assets not taken over but done what? But sold. But sold by A Limited. Now listen. What if you as company A, you have some assets which you could give them to company B under step 1. 2, you can't get somebody to buy them. That means you can't get somebody to sell to under step 5. As a company A, you have an asset which B refused to take it over. 2, you can't get anybody to buy it. Yet we are closing the books of company A. We are closing the books of company A. What do you do with such an asset? Yet we cannot leave the accounts pending. Listen, it means therefore somebody within the company must take over the loss of such an asset. Somebody within the company must take over the loss of such an asset. And who is it? it is obvious the ordinary shareholders, they are the owners of the company. They must take over the loss of such an asset. And you find in such cases, you find most of such assets are normally the intangible assets. Goodwill. Company B doesn't want to take it. You as A, you can't sell it. Copyrights, another example. Trademarks, patents. These are kind of assets which maybe the purchasing company doesn't want to take them over. And two, you can't sell them. You were saying mostly they are intangible assets. We normally refer to such assets as fictitious assets. We normally refer to them as fictitious assets. And therefore, I've said somebody must take over the loss of such an asset. Who? It is the ordinary shareholders. So our step number 9 says you transfer any fictitious assets. You transfer fictitious assets to the ordinary shareholders members, whether it is general reserve, maybe it is an intangible asset like copyright, trademark, goodwill, and so on. Whatever it is, you will credit that asset. We know assets are always a debit balance. So you will credit the asset and you debit the members. You give that loss to the members of the company who are the owners of the company, and they are the ordinary shareholders. So you will debit ordinary shareholders members here, and you will credit whichever the fictitious assets here, whatever it is, that fictitious assets, whatever it is. That's our entry number 9. Good. Now, before I go to number 10, listen. Before I go to number 10, listen. What I want you to remember so far, listen. I hope you are looking at this procedure. I just want to give you an overview so that you don't have to cram. Listen, you don't have to cram these entries. You just understand the flow. Once you understand the flow, then everything will be okay. So what did I start by doing? We started by closing the books up there. Like closing the assets taken over, liabilities taken over. Then I had to charge company B whatever is the purchase consideration. Now listen. Most of your past paper questions will not have entry number 5 and 6. Most questions in your past papers will not have entry number 5 and 6. You will always be told all assets were taken over. When you are given the question, you will be told the following assets were taken over. When you compare with the original assets in the balance sheet, you find all of them were taken over. Most questions, you will not find liabilities being paid by the purchasing company, by the selling company. No. I've just discussed those 2 entries just in case you will be finding them in a question, but they are rare. Number 5, with any assets not taken over but sold. That's a normal transaction. When you sell an asset, you just debit bank, credit asset. That should be a normal double entry. Number 6, with the liabilities not taken over but paid. That's a normal transaction. Whenever you pay a liability, you just debit liability and credit bank. You know that, okay? But I'm saying most questions will not have it. But number 1, 2, sorry. Yes, are you able to hear me? Sorry. Something has happened there. I don't know whether you're able to hear me now. Check and confirm. Something has happened. There was a disconnection somewhere. Tell me whether you're able to hear so that we continue. Check whether you're able to hear me now. There was a disconnection somewhere. Are you able to hear me so that we continue? Check. Oh, we can hear you clearly, Sawa. There was a disconnection somewhere, but if it's back, that's okay. Sawa. So I was saying this. Good. Let's continue. So I was saying, let me adjust so that it doesn't disturb me again. Let me adjust so that it doesn't disturb me again. Okay. So I was saying, most questions will not have number 5 and 6. But I want you to get the logic before I even go to number 10. That what I did, I had to close the books, create a data by the name of the purchasing company in terms of the purchase consideration. So number 1, 2, 3, and 4, those are entries you have to remember. Then after I did that, listen to this now. After I've done that, I hope you have realized that our entry number 7, 8, and 9, 7, 8, and 9, they are all related. In the sense that they are things that belong to who? The ordinary shareholders. Number 7, 8, and 9 are all related. And what was I doing? I was opening a liability account and transferring everything I owe to the ordinary shareholders to that account. So that when I come down there to pay them, when a time will come for me to pay them, I'm not going to pay them in piecemeal. So number 7, 8, and 9 is just to create a consolidated liability account for the ordinary shareholders. Listen, started by closing the accounts up there, creating a data in the name of the purchase consideration. Now I've opened a liability account for the ordinary shareholders so that when a time comes for payment, I'll pay them only once. Good. That's number 8. Number 9. Listen to this now. In your company, you may have other stakeholders. Like who? Like preference shareholders. So if you have other stakeholders, again, listen, again, you will consolidate everything that you owe to them in one account. Now, number 10 says, again, do the same. The way you did for ordinary, do the same for preference. So step number 10 says, you transfer the balance, again, transfer balance of preference share capital. Transfer balance of preference share capital to an account we shall be calling preference shareholders members account, so that you consolidate again everything that you owe to the preference into one account, so that when the time of payment will come, you don't pay them in piecemeal, you will pay them only once. So let me open that account, which we are calling preference shareholders members. We have opened a liability for the ordinary. Do the same now for another group of stakeholder whom we call preference shareholders members. Preference shareholders members. I want to transfer the balance of the preference share capital to this account. We know share capital is always a credit balance. You will debit share capital and you credit the members. You come and say a preference share capital. Preference share capital, whatever the amount. Good. Now listen. Is that the only thing you as a company you may owe the preference? The answer is no. What else could you be owing to the preference shareholders? Listen, as a company, you may not have paid the preference shareholders their dividends. Maybe for the last 2 years or 3 years, you have not been paying them their dividends. So the question might tell you, preference dividends are in arrears for the last 2 years. You remember, listen, we said when we were even doing internal reconstruction that preference dividends in arrears don't appear in the balance sheet. We consider them as a contingent liability. You remember when we were doing the topic of internal reconstruction, we considered them as a contingent liability. Then we said when we were doing internal reconstruction, now that we are reconstructing the company, you remember, we said you have to crystallize that liability. You had to crystallize that liability. And to crystallize that liability, we debited, that time, we debited capital reduction and we credited preference dividends in arrears. Now, we are dealing with external reconstruction. Now, listen, Now that we are dealing with external reconstruction, we have to crystallize again any preference dividends that are still in arrears. This time, I have a liability account for the preference shareholders. So I consolidate everything into that account. So number 10 stays, still under number 10. Still under number 10, we are saying, if there is any preference dividends in arrears, you will debit realization and you will credit preference shareholders members account. With any preference dividends in arrears, you will debit realization and you will credit the members account. We owe them that much with any preference dividends in arrears. So that's our step number 10. Okay, that's our step number 10. I go to number 11. I go to step number 11 now. I go to step number 11. Listen. For number 11, I want to take you back to number 3. For number 11, I want to take you back to step number 3. Step 3, we say, with the purchase consideration. At that time I told you, I am creating a data by the name of B Limited here. And I debited this purchasing company called B Limited. I credited realization. We were assuming an amount of 15 million. Now listen, a time has come for them to pay us that 50 million. A time has come for them to pay us that 50 million. So our step number 11 says, with the receipt of the purchase consideration, we are company A selling our business to company B. So let B pay us that 50 million. Now listen, company B may decide to pay that 50 million, all of it in cash, or they may decide to pay all of it in terms of shares by giving us their shares, or they may decide to give us their debentures so that we become debenture holders in their company. Or they may decide to pay us part of this in cash, part of it by giving us shares in that company, and part of it by giving us some debentures. Let me assume for now that the company B decided to pay this 50 million, part of it in terms of cash, let me assume 10 million, part of it in terms of debentures worth 20 million, and more so, again, the balance may be over another 20 million in terms of shares. So our step number 11 says, with the receipt of the purchase consideration, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. If you are receiving cash, come and debit cash by amount of 10 million. You credit the data here, which is B Limited. Come and see your cash, 10 million. If they are paying us in terms of debentures, you debit the account called debentures in B Limited by 20 million, and you credit the purchasing company 20 million. Listen, I am debiting debentures as an asset. We are not the company issuing the debentures. It is B who is issuing. So in their books, they are going to credit debentures because they are the company issuing. We are receiving the debentures of B Limited. So you will open an account called debentures in B Limited. You as A, you are receiving it as an asset, not as an issue. You're not the company issuing. Then, if you are receiving shares again, you will debit shares of A Limited. No, B, sorry. You will debit an account called shares of B Limited because you are receiving them again as an asset. What, how much? 20 million. You come and credit the purchasing company by 20 million. So that's our step number 11, which says, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, you will debit cash, you will debit debentures, you will debit shares, and you credit the purchasing company. Good. That's our step number 11. I related it to step 3 Because step 3, we only created an asset, no, a data. Now we are receiving from a data which says with the receipt of the purchase consideration. Good. Now, there are 4 more entries because they are normally about 15. But before we go to the others, I think it's time we put down what we have discussed so far. So maybe what we could do, let's put down those entries first in form of our entries now. So let's put down the topic, external reconstruction, put down the topic, external reconstruction. Put down the topic, external reconstruction. Then you say this. This occurs, external reconstruction. Then you say this. This occurs when a company is liquidated. And sell their business, when a company is liquidated and sell their business to another existing company, or a newly formed company. This occurs when a company is liquidated and they sell their business to another existing company or a newly formed company. Another paragraph. The selling company will be required to close their books. While the purchasing company, selling company will be required to close their books, while the purchasing company will be required to open their books. Okay, let's have another subheading. Entries in the books of the selling company. As a subheading, entries in the books of the selling company. 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 As a subheading, entries in the books of the selling company. Then you say this, number 1, entries in the books of the selling company. Number 1, sema hivi, close all assets taken over. Close all assets taken over at their book values. Close all assets taken over at their book values. Close all assets taken over at their book values to the realization account. Close all assets taken over at their book values to the realization account. Then you can put down the entry, debit realization, credit assets. Debit realization, credit assets. Debit realization, credit assets. That's number 1. We have said close all assets taken over at their book values. Maybe you can even underline the book value. That's important, because sometimes the question will give you, not sometimes, you will be given the market values, but those market values of those assets, we shall use them in the books of the purchasing. But in the books of the selling, we are using book values. Good. Number 2, put down this. Number 2, with the liabilities taken over. with liabilities taken over by the purchasing company, with liabilities taken over by the purchasing company, with liabilities taken over by the purchasing company. Debit, liabilities, you debit liabilities. Credit, we are saying you debit liabilities. Credit realization. Debit liabilities, credit realization. Debit liabilities, credit realization. Good. That's our entry number 2. We now go to number 3. We now go to number 3. Number 3 says, with the purchase consideration. Number 3, with the purchase consideration. With the purchase consideration. Debit, purchasing company. You in bracket, you can say data, because we are creating a data. You debit the purchasing company, in bracket data. Credit realization. Debit purchasing company, credit realization. That's number 3. We go to number 4 now. Number 4, you can say this. Number 4, with liquidation expenses. With liquidation expenses. With liquidation expenses paid for or incurred. With liquidation expenses paid for or incurred. With liquidation expenses paid for or incurred. Debit, realization. Credit bank, stroke, credit provision for liquidation expenses. If you paid, you credit bank. If you incurred but never paid, that's why we are saying you credit provision for liquidation expenses. That's number 4. With the liquidation expenses paid for or incurred, you will debit realization and you credit provision for liquidation expenses. Number 5. Number 5. Number 5. With any assets not taken over. With any assets not taken over. With any assets not taken over by the purchasing company. With any assets not taken over by the purchasing company, but sold by the selling company. With any assets not taken over by the purchasing company, but sold by the selling company. Debit, bank, credit asset. Debit, bank, credit asset. Debit, bank, credit asset. Then you say below that, NB, with the balance in the asset account, with the balance in the asset account being either gain or loss on disposal, with the balance in the asset account being either gain or loss on disposal, being either gain or loss on disposal, comma, transferred to the realization account. 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 That's number 5. Let's do number 6. Let's do number 6. Number 6 says, with any liabilities not taken over, with any liabilities not taken over by the purchasing company, with any liabilities not taken over by the purchasing company, but paid, with any liabilities not taken over by the purchasing company, but paid by the selling company, but paid by the selling company, debit, liabilities, credit bank. Debit, liabilities, credit bank. Debit, liabilities, credit bank. NB, note. NB, note. With any discount received from creditors, with any discount received from creditors, debit, creditors, credit realization. With any discount received from creditors, debit, creditors, credit realization. Credit realization. Okay. We go to number 7 now. We go to number 7. We go to number 7 now. Hope you are through. Number 7 says, transfer the balance. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Okay. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Put down the entry, debit, ordinary share capital, debit ordinary share capital, debit ordinary share capital, credit ordinary shareholders members account. Debit ordinary share capital, credit ordinary shareholders members. Debit ordinary share capital, credit ordinary shareholders members. Okay. That's number 7. If you are through, we've said close the ordinary share capital, the ordinary shareholders members. Just some minutes. Just some minutes. Okay, so let's go to number 8 now. Let's go to number 8. Let's go to number 8. Transfer reserves. Number 8. So maybe transfer reserves to the ordinary shareholders members. Transfer reserves to the ordinary shareholders members. Transfer reserves to the ordinary shareholders members. Then under that you can say this. Under that you can say this. Number A, if positive reserve, e.g. share premium, if positive reserve, e.g. share premium, if positive reserve, e.g. share premium, debit share premium, credit ordinary shareholders members. Debit ordinary share debit share premium, credit ordinary shareholders members. Okay. That is if positive reserve, e.g. share premium, debit share premium, credit ordinary shareholders members. Number B, if negative reserve, e.g. retained losses. If negative reserve, e.g. retained losses, debit ordinary shareholders members, debit ordinary shareholders members, credit P&L. Debit ordinary shareholders members, credit P&L. Debit ordinary shareholders members, credit P&L. Okay. That's number 8. Let's go to number 9. Let's go to number 9. Transfer fictitious assets. Transfer fictitious assets. Transfer fictitious assets to transfer fictitious assets to the ordinary shareholders members account. Transfer fictitious assets, the ordinary shareholders members account. Debit ordinary shareholders members, debit ordinary shareholders members. Remember we said they are going to take over the loss. You debit ordinary shareholders members, you credit fictitious assets. You can say in AG, credit fictitious assets, AG intangible assets. So those are the most common form of intangible. Those are the most common form of fictitious assets, the intangible. So we are saying transfer fictitious assets, the ordinary shareholders members, you debit ordinary shareholders members, and you credit fictitious assets. And we are saying in bracket, AG, intangible assets. Good. That's number 10. Number 9, sorry. That's number 9. We go to number 10. We go to number 10. We go to number 10. Number 10 we say, if you are there, number 10 we say transfer the balance of the preference share capital, transfer the balance of the preference share capital to transfer the balance of the preference share capital to the preference shareholders members. transfer the balance of the preference share capital to the preference shareholders members. Transfer the balance of the preference share capital to the preference shareholders members. Debit preference share capital, debit preference share capital, credit preference shareholders members, credit preference shareholders members. You debit preference share capital and you credit preference shareholders members. Credit preference shareholders members. Then below number 10, you can write NB. Number 10, NB. NB. With any preference dividends in arrears. With any preference dividends in arrears. With any preference dividends in arrears. Remember, we said it belongs to them. We debit realization and we credit preference shareholders members. Preference shareholders members. With any preference dividends in arrears. You debit realization and you credit preference shareholders members. Good. That's number 10. That's number 10. We want to go to number 11 now. We want to go to number 11, which we have already discussed, where I took you back to step 3, sorry. You remember I told you in step 3 we had to charge the purchase consideration. Now we are receiving. So let's put down the entry. By 11 says, put down this with cash, no, with the receipt, put it that way, with the receipt of the purchase consideration. With the receipt of the purchase consideration. With the receipt of the purchase consideration, either in form of cash, shares, or debentures. With the receipt of the purchase consideration, either in form of cash, shares, or debentures. With the receipt of the purchase consideration, either in form of cash, shares, or debentures. Debit, cash, stroke, shares, stroke, debentures. That means if you are receiving cash, you debit cash. If you are receiving shares, you debit shares. If you are receiving debentures, you debit debentures. And then you credit purchasing company. Purchasing company. Don't forget, listen, in our step 3, we created a data. Now we are receiving from that data. That's why we are crediting that data account, whichever the data. That's our step number 11. So allow me to go back to my discussion now, because those are the entries we have discussed so far. We want to continue from there to step 12, 13, 14, and 15. We are remaining with a few more to finish the entries in the books of the selling company. Okay? So allow me to discuss the remaining 4 before we put them down. So allow me to discuss the remaining 4. Okay, so let me go back to my original discussion. So let's go back. So we were at that point, listen to this now. We were at that point where we had just received the purchase consideration. What is step 12? Listen to this now. Listen to this now. We have just received cash, shares, and debentures under step 11. We debited cash. We debited shares. We also debited the debentures. I told you we are receiving them as assets. Now we want to use them. because we have the money now. We are company A. Now we have the money. We said, by the end of the day, the stakeholders must be paid what is due to them. So now we have two groups of stakeholders. We have the ordinary shareholders and we have the preference shareholders. The question is, who should we pay first? Now that we are liquidating this company, it is obvious, you know, whenever a company is liquidated, preference shareholders normally rank first in order of priority. So our step number 12 says, pay the preference shareholders. Pay preference shareholders what is due to them. The question will tell you, whatever cash you received or shares you received, what is it that you are using to pay them? You had opened an account called preference shareholders members here, down here. Where is it? Here. We owe them their share capital on the credit. We owe them their arrears on the credit. Now a time has come for you to pay them. If the question tells you you are giving them cash as a payment, then you go credit the cash and you debit the members here. Whatever it is, you credit cash. Remember, you debited it when you received it here. Now you come and credit it here and you debit the members. If the question tells you you are giving the preference shareholders some debentures, go credit the debenture and you debit the members. That's what I'm trying to say. Whatever it is that you are using to pay them. If the question tells you you gave them shares as a payment, you go credit debentures, you go credit shares, you debit the members. That's our step number 12, which says, pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in form of cash or shares or debentures. It is the question that will guide you what it is that you as a company A, you are giving to the preference. If the question tells you you gave them cash, fine. You gave them shares, fine. You gave them debentures, go credit whatever you are giving them because you received it as an asset. Now use it to pay. So you credit shares or you credit cash or you credit debentures and you debit the preference shareholders members. Good. That's our step number 12. Number 13. Now, listen. Let me just come here. Once you pay the preference shareholders what is due to them, listen, this account called preference shareholders members will always have a balance. I told you on the credit side, that's what you owe to them. On the credit side, that's what you owe to them in terms of share capital and arrears. On the debit side, this is what you are giving them as a payment. This is what you are giving them as a payment. Okay? Now, there will be a balance in this account. For purpose of illustration, let me assume you added the total on the credit and you got it as 2 million. But when you add the various forms of payment, you find it's 1,800. On the debit, all payments are amounting to 1,800, I'm assuming. On the credit, all that you owe to them amounts to 2 million. So if I'm giving them, let me start this way. If I owe them 2 million and I'm giving them 1.8 million as a payment, there's a difference of 200 on the debit. The question is this: is that a gain to the company or a loss to the company? Remember, we owe them 2 million on the credit side, but I'm giving them 1.8 million as a payment on the debit side. Then there is a balance of 200. Is that a gain to the company or a loss to the company? Somebody to chat and give me the answer. I've not asked you a question today. Is that a gain or loss on payment? We owe them 2 million on the credit, but when I add the various forms of payments to them, it amounts to 1.8. Now we are getting a difference of 200. The question is, that 200 to us as a company, is that a gain or loss? Somebody? Somebody, is that a gain or loss? You chat and tell me whether it's a gain or loss. Thank you. It's obvious. It's a gain. Thank you. It's a gain because we are reducing what we owe to them. We owe them 2 million, but we are paying them less. So to us as a company, that's a gain. So where do you take it? Now listen, you take it again to the account we are calling realization account. You take it to an account we are calling realization account. So that's our step. Alternatively, it could be you owe them 2 million on the credit, but when you add all the various forms of payment, you find it's coming to 2.8 on the debit. If the payment is more than what you owe to them, then you are paying them more than you owe to them. That's a loss to the company. That's a loss to the company, which in this case will be a credit of 800. That's what you take again to the realization account. So our step number 13 is saying here, our step 13 here says, with the balance in the preference shareholders members, balance in preference shareholders members account, that balance could either be a gain or loss on payment. If it's a gain, you will debit the members account and you will credit realization. If it's a loss like the 800 we have seen, you will credit the members and you debit realization. Okay? Good. That's our step number 13. Number 14. Listen. As a company A, we are selling our business to B. So the question is, are we selling our business at a gain or are we selling our business at a loss? That's another question we need to know. We as company A, we are selling our business to company B. But the question is, are we selling our business to company B at a gain or loss? Now, to know whether you are selling your business at a gain or loss, you come to this account we are calling realization account. I told you, it's our operating account. So we want to get the balance in this realization account, and the balance in this account will either be a gain or loss on realization. We are selling our business as company A. Are we selling it at a gain or loss? That's what we want to know. Now, on the debit of this account, if you look carefully, those are the assets I gave out, plus the expense I incurred called liquidation. On the credit side, that's what I'm going to receive as the purchase consideration. Now, if the credit side is more than the debit side, it means what? It means I'm giving out less than what I'm receiving. Or in other words, I'm saying I'm receiving more than what I'm giving out. We are selling our business. On the debit, there are assets I've given out, plus the expense I've incurred. On the credit, I'm charging this company 50 million. Suppose the credit side is more than the debit. It means I'm receiving more than what I'm giving out. So as a company, we are gaining. That difference will be on the debit side. That's obviously a gain. Yes, selling the company at a profit, correct. Thank you. We are also saying, what if what you are giving on the debit now is more than what you are receiving on the credit? If you are giving out more than what you are receiving, then obvious you are selling your business at a loss. So that loss will be on the credit side. So the question is, listen, the question is, who takes over the gain or loss of selling this business? It is obvious the owners of the company will have to take over the gain or loss on selling this business. Who are the owners of the company? The ordinary shareholders. So let us assume the difference was on the debit side. You will debit realization and you credit ordinary shareholders members. ordinary shareholders, members, if it's a gain. Otherwise, if it's a loss, you will credit realization and you debit the ordinary shareholders, members. Now I'm assuming it's a credit, it's a gain, sorry. I have to debit realization and credit the ordinary shareholders, members here. Like come and see here, realization, it's a gain, whatever it is. That's our step number 14, which says, with the balance in the realization account being either gain or loss on realization, you will debit realization, credit the ordinary shareholders, members if it's a gain. Or in other words, whatever is the balance in the realization, just transfer it to the ordinary shareholders, members. Good. That's our step number 14. Listen to this now. 15 and the last one. 15 and the last one is, listen, the ordinary shareholders normally are the last people to be paid whenever a company is liquidated. You remember we have already closed the account called preference shareholders, members. That one you know. Now we want to pay the last group of stakeholders who are the ordinary shareholders. So you come to this account called ordinary shareholders, members. Again, you owe them whatever. Okay? So you will go through the question again. You will ask yourself, what is it that we are giving to the ordinary shareholders? Remember, you could have received cash, shares, or debentures. Under step 11, where we said with the receipt of the purchase consideration, either in cash, shares, or debentures. If you received cash, you debited cash. If you received shares, you debited shares. If you received debentures, you debited debentures. Now a time of payment has come. What is it that I'm giving to the ordinary shareholders? If the question tells you are giving them cash, go credit cash, debit the members. Just like you did for preference. If the question tells you are giving them debentures, go credit debentures, debit the preference. The ordinary shareholders, members. If you are giving them shares, go credit shares, debit the ordinary shareholders, members. That's our step number 15, which says, pay the ordinary shareholders what is due. Our 14th step here was the balance in the realization. That was the balance in the realization, being either gain or loss on realization. Number 15 and the last one now we are saying, pay who? Pay the ordinary shareholders what is due to them, either in cash or shares or debentures. Okay? Now, before we put down the 4 remaining ones, I hope you don't have to cram these entries. What is more important is this. Just understand the flow. I started number 1 to 4, closing the books and creating a data by the name of the purchasing company. After I did that, listen, I said number 5 and 6, not a must in a question. Not a must in a question. Listen, 5 and 6, not a must. 7, 8, and 9, must. What is that? I was creating a liability account for the ordinary. That's what I did in step 7, 8, and 9. Then 10, I did the same for preference shareholders. Get the flow. I started by closing the books. Now I've created the liabilities for ordinary and the preference. Once I do that, now I receive the purchase consideration, which was our step number what? 11. Either in cash, shares, or debentures. Once I receive, now I start asking myself, who do I pay first? You pay the preference, either in cash, shares, or debentures. Then you pay, get the balance in the realization, saying whether you are selling your business at a gain or loss. Then finally you pay the preference are the ordinary shareholders. I hope you are getting the flow. Closing the books, creating the liabilities for the stakeholders, receiving the purchase consideration. Once you receive, start paying the stakeholders what is due to them. Okay? Good. That is the flow I want you to understand, not to cram. Closing the books, assets and liabilities, creating a data, liquidation expense. Then number 7, 8, and 9, open an account called ordinary shareholders members for everything that you owe to the ordinary. That means you create a liability for the ordinary. 10, do the same for preference. 11, receive the purchase consideration. Then you start paying the stakeholders. Now that you open an account for them, you start paying them what is due to them. Good. So let's now record or make the notes for the remaining 4 entries. We were at point number 11. Now let's continue with the notes for number 12, 13, and 14. Good. Let's put down number 12. Let's put down number 12. So we have received. Number 12 says now, pay the preference shareholders. Put down, pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. Pay the preference shareholders what is due to them, either in form of cash, shares, or debentures. Debit, preference shareholders. Debit preference shareholders. Members. Credit cash, stroke shares, stroke debentures. Debit preference shareholders members, credit cash or shares, stroke debentures. That's our step number 12. Okay, we can now go to step 13, sorry. Let's go to step number 13. Let's go to step number 13, which says what? Number 13 says, with the balance in the preference shareholders members, with the balance in the preference shareholders members being either gain or loss on payment, being either gain or loss on payment, with the balance in the preference shareholders members account being either gain or loss on payment, comma, transferred to the realization account. Transferred to the realization account. Transferred to the realization account. Then you say number A, if gain, debit, realization, debit preference shareholders members, debit preference shareholders members, if gain, debit preference shareholders members, debit preference shareholders members, credit realization. If gain, debit preference shareholders members, credit realization. Number B, if loss, debit realization, credit preference shareholders members. If loss, debit realization, credit preference shareholders members. That's our step number 13. We want to go to number 14 now. We want to go to number 14. Number 14 says, with the balance in the realization account, 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 being either gain or loss on realization, with the balance in the realization account being either gain or loss on realization, comma, transferred to the ordinary shareholders members, with the balance in the realization account being a gain or loss on realization, transferred to the ordinary shareholders members. Transferred to the ordinary shareholders members. Then you say number A, if gain, debit, realization, credit ordinary shareholders members. If gain, debit, realization, credit ordinary shareholders members. That is if it's a gain on realization. Number B, if loss, that means you sold your business at a loss. We said you debit ordinary shareholders members, debit ordinary shareholders members, credit realization. Debit ordinary shareholders members, credit realization. That's our step number 14. To finish, we want to go to number 15 and the last one. We want to go to number 15 and the last one. You can say this. Pay the ordinary shareholders. Pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them, either in form of cash. Pay the ordinary shareholders what is due to them, either in form of cash, shares, or debentures. Pay the ordinary shareholders what is due to them, either in form of cash, shares, or debentures. You debit ordinary shareholders members. You debit ordinary shareholders members, credit cash, stroke shares, stroke debentures. Good. That is it. Okay. So maybe for today we can stop there. Next time I do the books of the purchasing company now. So next time I will deal now with the entries. There are not many like in the books of the selling. When we shall be discussing this now, books of the purchasing company, there are not many like the ones for the selling company. Those ones are fewer. Then once we discuss the entries in the books of the purchasing company, we do a past paper question there. Okay? So allow me to stop there for today. Next time we go through the books of the purchasing. There are about 6 entries. There are not many there. There are about 6. Once we discuss the books of the purchasing, we do a past paper question. Okay? But what I have said as far as the books of the selling is concerned is to understand the flow, not to cram those entries. The flow is close the books, create a data by the name of the purchasing company, create liabilities for the ordinary and preference, receive the purchase consideration, then you start paying the stakeholders. And that way you are liquidating the company A. Good. So allow me to stop there for today. We pick it up from there next time.